How money really works. Money is one of the most powerful inventions in human history, yet it remains one of the most misunderstood. Most people think of money as coins in their pocket, numbers in a bank app, or dollars earned from a paycheck. In reality, money is a complex system of trust, debt, and institutional power that shapes every aspect of modern life. Understanding how money truly works reveals why economies boom and bust, why the rich get richer, and why everyday people often feel stuck in a cycle of inflation and debt. This article dives deep into the mechanics, history, and hidden realities of money in the American context, explaining the system that governs trillions of dollars flowing through the global economy. At its core, money serves three primary functions: a medium of exchange, a unit of account, and a store of value. Without these, trade would collapse into barter, making complex economies impossible. Historically, money evolved from commodities like shells, beads, and precious metals. Gold and silver became dominant because they were scarce, durable, divisible, and portable. The US dollar itself was once backed by gold under the gold standard, but that changed dramatically in the 20th century, leading to the fiat money system we have today. The shift away from commodity-backed money began in earnest with the Federal Reserve Act of 1913. Congress created the Federal Reserve System, America's central bank, to stabilize the economy after a series of banking panics. What few Americans realize is that this system fundamentally altered how money is created. Under the gold standard, money supply was limited by physical reserves. Fiat money, by contrast, is created by government decree and backed only by trust in the issuing authority. Today, the dollar is the world's reserve currency, giving the United States enormous economic leverage, but it also exposes the system to unique risks. To understand modern money creation, consider how banks operate under fractional reserve banking. When you deposit $100 in a bank, the bank is required to keep only a small fraction, often around 10% or less, as reserves. The remaining $90 can be lent out to another customer. That borrower then deposits the $90 in another bank, which lends out $81, and the process continues. Through this multiplier effect, an initial $100 deposit can create nearly $1,000 in new money supply. This is not abstract theory, it is the engine of credit expansion in the American economy. But banks do not simply lend out existing deposits. In practice, banks create new money when they issue loans. When a bank approves a mortgage or business loan, it credits the borrower's account with new digital dollars that did not previously exist. The money is created out of thin air, balanced by the debt obligation on the borrower's side. This debt-based money creation means that most money in circulation today exists as bank credit rather than physical cash. According to data from the Federal Reserve, the vast majority of the M2 money supply, checking accounts, savings, money market funds, is digital, created through lending. The Federal Reserve sits at the apex of this system. It controls the federal funds rate, conducts open market operations, and engages in quantitative easing, QE. During the 2008 financial crisis and again in 2020 amid the COVID-19 pandemic, the Fed purchased trillions of dollars in assets, injecting liquidity directly into the financial system. When the Fed buys treasury bonds or mortgage-backed securities from banks, it pays by crediting the bank's reserve accounts at the Fed. Those reserves become the basis for even more lending. This process expands the monetary base and, through the multiplier, the broader money supply. Critics argue this system favors asset owners and financial institutions. When new money enters the economy, it flows first to banks, corporations, and investors who have access to credit. They buy stocks, real estate, and commodities, driving up prices. By the time the new money trickles down to wages and consumer goods, inflation has already eroded purchasing power. This phenomenon, sometimes called the Cantillon effect, explains why housing prices skyrocketed after the 2008 QE programs, while many middle-class families struggled with stagnant wages. Inflation is perhaps the most visible consequence of how money works. The Federal Reserve targets around 2% annual inflation, viewing mild inflation as a lubricant for economic growth. But persistent inflation acts as a hidden tax. If prices rise 3% per year, the purchasing power of your savings declines steadily. A dollar saved today buys less tomorrow. Between 2021 and 2023, US inflation surged above 9% at its peak, driven by massive pandemic stimulus, supply chain disruptions, and energy shocks. Real wages for many workers fell even as nominal pay increased. The mechanics of inflation tie directly to money supply growth outpacing economic output. When the Fed prints money faster than goods and services are produced, too many dollars chase too few resources. Velocity of money, the rate at which dollars change hands, also matters. During economic uncertainty, velocity slows as people hoard cash, muting inflationary pressure. But once confidence returns, velocity can accelerate, amplifying inflation. Government debt plays a central role too. The U.S. national debt exceeds $35 trillion as of 2026. The Treasury issues bonds to finance deficits, and the Fed often buys a portion of them. This monetization of debt allows the government to spend without immediate tax increases, but it risks eroding confidence in the dollar long term. Interest payments on the debt now rival major budget categories like defense. If investors lose faith, yields spike, making borrowing more expensive for everyone, from the government to home buyers. Foreign holders of U.S. debt add another layer. Countries like China and Japan hold trillions in treasuries because the dollar is the dominant reserve currency. This status lets America run persistent trade deficits, essentially exporting dollars in exchange for imported goods. Petrodollar recycling, where oil is priced in dollars, further cements this dominance. However, de-dollarization efforts by BRICS nations and the rise of alternatives like the Chinese yuan signal potential challenges ahead. Understanding money requires examining the shadow banking system and derivatives. Beyond traditional banks, investment banks, hedge funds, and money market funds create credit-like instruments that behave like money. The 2008 crisis exposed how complex mortgage-backed securities and credit default swaps amplified systemic risk. When trust evaporated, liquidity froze, forcing Fed intervention on an unprecedented scale. Central bank digital currencies, CBDCs, represent the next evolution. The Fed has explored a digital dollar, which could allow direct transactions between the central bank and citizens, bypassing commercial banks. Proponents argue it would improve efficiency and financial inclusion. Critics worry about privacy, surveillance, and the potential for programmable money, dollars that expire or can only be spent on approved goods. While the US has not launched a full CBDC yet, pilot programs and research continue. Bitcoin and cryptocurrencies offer a contrasting vision. Created in 2009 by the pseudonymous Satoshi Nakamoto, Bitcoin is a decentralized digital asset with a hard cap supply of 21 million coins. It operates on blockchain technology, a distributed